In this segment, we are going to cover the topic of forms of ownership for a business. Now, there's several main types of ownership, and I'm going to cover these briefly. You should definitely read the text and also look at the complete set of slides. The easiest form of business is a sole proprietorship. Sole proprietorship, as its name implies, is just the individual setting up a business. You can go out and cut somebody's lawn and you're a sole proprietor. You can be a CPA and start doing the books for a business and you're a sole proprietor. You can be a lawyer and do your own legal advice as a sole proprietor. You have complete control. You have no paperwork. It's easy to do. Your money you make from the business is your personal income. It's all very straightforward. There are several things that are disadvantages, however, and one of the huge ones is the fact that in a sole proprietorship, the sole proprietor has unlimited liability. What that means is that if you are an auto mechanic and you fix somebody's car and the wheels fall off and there's an accident due to your negligence, you are personally liable, responsible for that. You can be sued personally. They can go after your home, they can go after your car, they can go after your investments, your savings. You are personally liable. Also, if you're a lawyer, for example, you might not have all the skills that you need. You might not have all the information you need on tax laws or estate laws or real estate law. You may also lack financing. You want to expand your business. You want to create a larger restaurant. You may not have enough money to do that. And lastly, when you leave the business as a sole proprietor, that's the end of the business. You are, in every sense of the word, the business. Now, another thing that kind of ownership that will address some of the issues that we have with a sole proprietorship is a partnership. Partnership, you bring in other people. They can contribute money. Now, they may also contribute skills. In return, of course, they're entitled to probably some profits. All this needs to be spelled out in a partnership agreement. Who does what? Who's going to do what work? Who's going to get what profits? Who's putting in what money? Problem with a partnership is that there is still unlimited liability. The partners have unlimited liability and can be personally sued. Now, there's a form of limited partnership where some of the partners, called limited partners, do not have unlimited liability. The liability is limited to the amount that they've invested. But there always must be a general partner, at least one, who has unlimited liabilities. Well, it was recognized well over 100 years ago that this is a problem, and so corporations were created. Now, think about this. If you were going to become an owner, say, in a car company, would you want to personally be sued if the brakes didn't work on a car you made or the gas pedal stuck and people got into accidents? You would not want to be personally sued. So the idea of a corporation was invented. Corporation is something that's legal. It can own property, assets, we've talked about that. Signs contracts, can sue, be sued. In the United States, you can tell a corporation by the use of the term incorporated or Inc. In England, you'll see LTD for limited liability. And other countries have their own designations. But most developed countries have corporations. The idea is you want investors to be able to invest in corporations without having to have unlimited liability. So the owners are shareholders or stockholders. What the stockholders do is elect a board of directors. The board of directors oversees the major decisions of the business. They will approve or disapprove of mergers and acquisitions, which we'll talk about in a minute. They approve dividend payments or profits that go back to the shareholders. They are there to represent the shareholders in the governance of the business. But they don't manage the day-to-day activity of the running of the business. That is handled by the CEO. And the board of directors hires the CEO to run the business. Now, besides having limited liability, corporations can sell more stock, raise money. And when the people that are running the business decide to move on to do other things, the corporation will continue on. Now, there's a couple of issues with a corporation. One of the big problems is that it's cumbersome. It's difficult to create. A lot of paperwork. You have to have board of directors meetings. You have to publish minutes, and there's a lot of work that goes into that. In addition, there's something called the agency problem. The agency problem is where the management of the business may have a conflict of interest. The conflict arises between they are supposed to represent the shareholders, but they also are looking out for their own interests, and sometimes these may conflict. For example, a salesperson is supposed to represent the corporation and the owners, and look out for the business, but maybe they get a bonus for recognizing a certain amount of sales in a given year. They might do things to increase sales to help their bonus, but it might hurt the business overall. This gets particularly difficult when you get executives who can make major decisions that would affect their income versus that of the shareholders. Another problem is that corporations are subject to double taxation. When a company makes profits, we saw in the income statement that they have to pay taxes before you get to net income. So corporations are taxed as an entity. Now, when they pay dividends, the result of those profits going back to owners, when the owner receives those profits are taxed again as personal income tax. So you can see that the profits as they flow through the corporation first get taxed inside the company and then get taxed outside the company when the owners receive them. We call that double taxation. Now, one of the things that was done to help solve the problems of a major corporation or corporations is the creation of a limited liability company. This is a relatively new invention. And the idea is that it's much simpler to create than a corporation. You can go on New Jersey website and create an LLC right now for $150, and clicking on some buttons, you can form an LLC. LLCs may have only one owner, or they may have multiple owners. Besides being easy to use, as the name implies, a big advantage is it has limited liability for its owners. So if your LLC is a car repair shop and you fail to put on the wheels properly, you personally don't get sued, but your LLC is sued. There's no double taxation. The income from the LLC can flow directly to owners, so there's no taxation within the corporation. We tend to think of these LLCs as small businesses because they're easy to start up, and so that entrepreneurs can form LLCs. But LLCs may also be large. We have cases where large car companies have been LLCs, and many banks are LLCs as well. Now, I want to turn briefly to the topic of mergers and acquisitions. Mergers are when two companies combine as equals. An acquisition is when one company buys another company. And there's three types of mergers and acquisitions. The first is horizontal, Horizontal companies are businesses that do the same thing and they come together. For example, Daimler-Benz merged with Chrysler and became Daimler Chrysler. Now we have Fiat Chrysler. And two car companies joining together to create one business is a horizontal merger. Vertical mergers are a little bit more difficult to understand. Let me give an example. For over 100 years, Coca-Cola made Coca-Cola formula, but never bottled a single bottle or can of Coke. Those were done by independent companies and distributors. Coca-Cola decided that they wanted to have control of those distributors and decided to start buying them. That is a vertical merger, an example of a vertical merger or acquisition. It's when two businesses in the same value chain, the creation and distribution of a product, when two companies in that chain merge, that is a vertical merger. Apple doesn't do any of its manufacturing. That's done by a company called Foxconn. If Apple should happen to purchase Foxconn, that would be a vertical merger. If Dell bought Intel, that would be a vertical acquisition. Finally, we have a conglomerate. This is where two businesses that are completely unrelated decide to join together. That would be like Pepsi and Firestone Tire merging. That would be called a conglomerate. All right, we've briefly gone over these. I really recommend you look at the slides. There's some additional information in the slides that would be good for you to be familiar with, particularly if you're interested in being an entrepreneur.